The biggest difference is that under the new accounting rules, or using CECL, which came out a few years ago, the biggest difference that I think is important to distinguish is that the intent of CECL is to effectively take the expense for lifetime losses immediately. So effectively, you've covered your lifetime losses, whereas fair value doesn't have that nuance, and you wouldn't be effectively expensing your lifetime losses immediately. After today, in a sense, if we originated the same loan under both methodologies, you'd be wildly profitable under amortized costs going forward, whereas I could argue that even based on current cost of capital and expenses.
So CECL is current expected credit losses. It's a new accounting framework that was introduced a couple of years after Dodd-Frank, right? Do you want to introduce what CECL is?
In a sense, the biggest change with CECL is that there used to be more of a model or an estimated framework for taking an allowance for loan losses, where you kind of took estimable loan losses. And there were some nuances and some differences between the way some companies would look at that. What would the coverage be? Would it be 12 months, 18 months, 24 months? We could debate. There were some points that were debatable, whereas under CECL, the intent was to normalize the accounting treatment and it also makes it more conservative, because what you would do is take the lifetime estimated losses as your allowance for loan losses immediately. You'd make estimates to the changes after that. But one thing that's important is that when you then, something that will probably come up later in this discussion is allowance for loan losses are loss absorbing capital, which is not, in some ways, you could argue that when you have a positive fair value number, you have negative loss absorbing capital on that one. Because you've actually taken the forward earnings and not taken the provision to cover yourself.
The simple way to think about it, with CECL, you take your lumps up front. When you originate a loan, you recognize on day zero the expected expenses over the life of the loan, including those losses.
It's really just the losses and maybe taking a accrual for some marketing expenses. You don't take the other aspects into account there. The way I would describe it is, if you took, as an example, and I realize that I'm picking on Lending Club here more specifically, but if you took where Lending Club has their loans marked using this framework, I would argue that that book value or that value has positive forward value because they haven't pulled forward. And if the loans are arguably probably worth more than where they're marked. So that book value, I mean, even if you ran the current cost of capital and things like that, cost of servicing, estimated credit, I could argue that even based on the current numbers for SoFi, that the actual accounting return for those loans would probably be negative in the future.
Ultimately, you've got an accrual, which is an accounting concept that's designed to match revenues and expenses. But these two approaches ultimately will wash out over time, especially as the cash flow comes in from these loans that were dispersed.
I think that's right, but I would make one very big nuance there. If for one loan over the life of the loan, that's true. But I'm borrowing some of the terminology or descriptions that others use, but a lot of people refer to fair value as a treadmill that keeps on accelerating that you have to keep up with. So while that may be true today, looking at the portfolio over the life of the portfolio, that would even out. If you, assuming you're continuing to mark loans at a positive fair value going forward and you continue to grow, you're just going to continue to grow the amount of positive fair value that you've accrued. So in some ways, while that's true for one loan over the life of the loan, it's wildly different going forward. And I would argue that it actually compounds the difference over time rather than reduces it.
Fintech VCs know this. I haven't found a tech VC that owns SoFi stock. By the way, I agree.